My name is Eric, and I'm the AASB Research Principal. It's a pleasure for us to have you with us today as we talk about digital financial reporting. This is a relevant topic to the AASB work because the AASB recently added digital financial reporting to its work program as a monitoring project. Now, I'd like to first introduce Amir Ganda, who is the Reporting and Assurance Leader of the Chartered Accountants, ANZ. Amir has an impressive background. He has extensive professional services experience in Australia and overseas, such as London. He spent a period of time at the International Federation of Accountants as the Deputy Director of Public Policy and Regulation. And many of us in Australia would know Amir quite well because his passion for accounting, reporting, and auditing. So we're grateful to have you, Amir, to chair the session. I'm going to hand the session over to you.
Thanks so much, Eric, and thank you all for joining us today. I'm beaming out here from Gadigal country. I'd like to acknowledge the elders, past, present, and emerging, and really thank, I guess, the AASB for your work in putting together this and the other sessions in the series, as well as CPA Australia. Of course, it's a real privilege to be able to host this session. Certainly, maybe one of the things I'm most passionate about, and I don't think I'd be overstating it to say if there was one thing that I think is more important than any other thing when it comes to reporting or auditing policy, standards, legislation, regulation in Australia, it's the adoption with urgency of digital reporting and making it mainstream. We have also, as well as our panel and main presenter with us in the room, Ram from CPA Australia, as well as I believe David from the IASB. I'll just note that the session is being recorded. For those in the audience, you can ask a question at any time through the Q&A box. And the presentation and comments made by the presenters and the discussant and me are not necessarily the views of our organisations. And so without further ado, I'm really glad to introduce our featured keynote speaker for today, Professor Indrit Trashani, Accounting Systems and Data Analytics at the Adelaide Business School at the University of Adelaide. Professor Trashani is a professor in accounting systems and data analytics. He has published in the area of digital corporate reporting, including XBRL technology and implications on accounting standard setting processes. And his work is published in all of, the really key, many key journals. And recently a great report that he did with CPA Australia on, the digital reporting adoption across the G20. So without further ado, over to you, Professor Trashani.
Thank you very much for the invite. It's a real honor and privilege to be contributing to this dialogue in relation to digital corporate reporting and to be with the panel experts. So I am going to share the screen. I have prepared some PowerPoints that probably will help. Basically, can you see my screen?
That's working perfectly, thank you.
Thank you. That will help basically just make sure that there is so much to talk about in relation to digital corporate reporting. And I want to make sure that I stick with the theme, digital corporate reporting, why does it matter? And in that particular space, I've got an agenda that contributes that I thought will help me make sure that I'm addressing that theme. And to start with, I will just talk a little bit about digital corporate reporting generally, and to make sure that I talk about address some of the misconceptions in relation to the technology, and who can benefit from it, and also bring in basically some of the demonstrated benefits in relation to who are the key stakeholders in the business information supply chain and the manner in which they can benefit from digital financial reporting, who's using it around the world, and also some further developments, and also taking stock basically on research that we have done and also that we have read based also on other academics research. I just wanted to touch on a few points basically about what research tells us about digital financial reporting, and also what are the key elements to have in place, all right, so that we can have eventually an effective adoption of it. So in terms of what is digital financial reporting, it is basically an important point that we need to make, that there appear to be a lot of misconceptions in terms of what digital financial reporting is, in the sense that many people still think that digital financial reporting is the same as electronic financial reporting. So essentially, they seem to put an equal sign between DFR and also PDF documents. They're not, they use those two terms interchangeably. That's not it. They are completely two different things. All right, so to start with, digital financial reporting and the underlying technologies such as XBRL and more recently inline XBRL or simply iXBRL, what they do is that they create capacity to capture and present financial data at a granular level. And of course, when you think about that, the first point is, well, what the hell does that mean? What does it? Now, if you look at this, for example, this particular financial report, so I've pinched the FRS Foundation's financial report. On the right-hand side, it looks like a normal financial report. It is presented on a website. However, underneath, the internal structure of this document is that it captures the individual data points. So every data point, every disclosure is internally represented, all right, by using this technology XBRL, all right, tags, all right, and obviously what we see as humans, it's obviously we will see what we see in the right-hand side, but internally the document is structured like that ugly, all right, code that we can see on the other side. Okay, now why is this important? It is important because of it enhances accessibility of financial information. All right, and what comes with accessibility is obviously this automatic extraction of an analysis of various disclosures. So if I'm comparing a digital corporate report vis-a-vis a PDF document, so in that sense, a PDF document is quite dumb in that sense, because the computer that sees a PDF document is none the wiser. It doesn't know about the data points that are being reflected as part of that particular report. However, if you are looking at the XBRL equivalent, then the computer technically will know of the information that is captured in there or that is shown in there. And in that particular capacity, one can pull basically with the right tools, obviously, one can pull the right data and also do analysis. So this is basically in essence what this technology, all right, actually helps achieve. Now, at a high level, we might wonder, well, what are the benefits? So the so what and who cares questions. At a high level, obviously, this means that we are likely to have better informed investment decisions and therefore more effective capital allocation. But in the broader, because of the enhanced transparency, the wider society can also benefit from improved corporate accountability. Now, again, going now a little bit more specifically to the theme, well, why does it matter? So there is lots of academics who've done literature review studies, and more recently, there is a couple of papers, one from Hoytash and colleagues, and the other one that I've done with a colleague from the University of Birmingham, Nick Robotham. And what we looked at is we took stock of all academic publications, okay, that are published in the space of digital corporate reporting. All right, so the benefits that have been evidenced, we categorize them in terms of the various stakeholders. For example, what we found basically, the research had evidence that there is a reduced cost of capital and debt. The technology or digital financial reporting helps improve the efficiency of both internal and external processes. It helps reduce regulatory compliance costs. And of course, also it helps reduce auditing costs of financial reports. But the other part that is quite interesting is that it helps basically in the sense that preparers will have greater confidence that users of financial information are looking at as reported information. And these are some of the benefits that were demonstrated in relation to preparers. What else? In terms of users, whilst the benefits of having technology in the area of financial reporting for professional investors have been demonstrated with the technology, with digital financial reporting, those benefits become greater for non-professional investors. That's why the term in the earlier days and even now is that XBRL, or digital financial reporting, brings greater democratization, I can't even say that word properly, to the financial markets, in the sense that the non-professional, the mom and pop investors using some tools can basically go and pull financial data in digital format and make their analyses and to inform decision making. All right, and the beautiful thing, or the beautiful part of this, is that they can do that across large samples. All right, they can pull information for various preparers or issues across various jurisdictions, and as I will demonstrate a little bit later, it can be done in a very easy way. And again, because of the improved transparency, there is also a great improved risk assessment of these particular target companies. In terms of regulators, regulators can also benefit by having enhanced compliance, monitoring, and also supervision. And again, this has been demonstrated in research as well. For example, APRA equivalent in the US, they have adopted the technology a while back, and the FDIC basically, and there is research basically that has demonstrated the benefits of the technology. Auditors, all right, there is improved audit outcomes in terms of instead of capturing, for example, a sample, the technology, because of that accessibility, it enables using a whole population of transactions, so they can audit as opposed to samples. And the other part that offers, if done right, the other benefit is continuous auditing. So instead of doing these audit engagements once a year, technically the technology can facilitate continuous auditing. And obviously, when one can do that, there is greater scope to catch, for argument's sake, or identify risk areas or potentially fraudulent transactions closer to the time when they have occurred, as opposed to later in the piece. So the benefits, again, are demonstrated in that sense. Now, let's go back now a little bit to who's doing this, okay? And I think it's an important question. So we looked at the International XBRL Consortium, all right, it deals with the technology at an international level. And essentially over there, you can see that there are just over 200 digital financial reporting, or XBRL, projects around the world. However, if we're looking at more narrowly at capital market projects, there are just about a quarter of those, so 57 projects. What is interesting to observe in this particular PowerPoint here, and again, I've pinched this from XBRL International, you see that in the last couple of years, there is a sharp rise, a very sharp rise of these projects in capital markets. All right, which means that, to me, the message here is there are many, and you'll see a little bit more information who is doing that specifically. This technology, I mean, all of these regulators and all of these projects that are happening around the world, they must see something about this. All right, and obviously the evidence of those benefits materializing helps that. More recently, we had Nick and I basically, we got funding, and I'd like to acknowledge CPA Australia for that, to look at the adoption of DFR in G20 jurisdictions. We also included in the sample another few countries like Hong Kong, Malaysia, New Zealand, and Singapore as countries that are part of the where CPA Australia has got membership. And if you look at that particular diagram, that little chart that I have there, you will see that there are 13 projects in those significant jurisdictions, basically, that are focused specifically on capital markets. And that includes obviously both the EU and also the US. All right, and what else? Of all of these projects, there are obviously 13 of them. All right, the majority of them, 10 of them are actually mandated projects. All right, so in other words, the regulators or stock exchanges, who are the key players that have taken it upon themselves, all right, to mandate and to manage basically digital financial reporting. There is 10 of them, all right, and of those, obviously 6 are using iXBRL, whereas 4 are using just the plain good old XBRL. Okay, but the vast majority again are using that, and only 3 jurisdictions basically have done are still running voluntary capital market projects. Now, in what way is XBRL or digital financial reporting being used? Of those 13, of those 10 projects that were mandated, we have basically, you can obviously see the countries there, pretty much everybody, all right, are using the technology for the reporting of primary financial statements. However, some are being a little bit more adventurous, all right. In the EU, for example, the UK and the US, they're also using the technology to tag notes, all right, notes to the statements. In Mexico, they're doing management commentary. And of course, there is also in the UK, they are using the technology to tag also sustainability disclosures. And that's quite interesting because all of these trends are obviously saying something about these markets. They must be seeing something in this technology. And going forward, we'll also see something else that is even more interesting, because the technology is also being considered for the sustainability reporting. All right, for argument's sake, look at this little press release, I believe it was, from the European Council. All right, so it says there, Council adopts its position on the Corporate Sustainability Reporting Directive. And if you look at the little line which I've highlighted, and I've provided everything for context, it says that it also provides a digital access to sustainability information will become a requirement. Okay, so to me, that is saying something. A significant jurisdiction like the EU want to use the technology for sustainability disclosure as well. And again, early in the year, US proposed these rules on the enhancement and standardization of climate-related disclosures for investors. And of course, I've removed everything else that is not relevant, but I've kept this particular bullet here, is that to electronically tag both narrative and quantitative climate-related disclosures using inline XBRL. There's another example that, well, the world basically is moving heavily into that direction. Now, if I go back to our report funded by CPA Australia, and when we looked at all of these jurisdictions, we noticed that there are 3 main themes. All right, in some jurisdictions, the regulators came about and said, those shall do it. All right, go ahead and do this. And obviously, they came up with a mandate. In some other jurisdiction, they said, oh yeah, I mean, let's have some voluntary projects first. But then there was a prospect of a mandate later down the track. And there is also a minority of jurisdictions whereby there was voluntary projects without the prospect of a mandate. And obviously, well, the finding that we have is that in the first 2 categories, all right, what we notice is that obviously adoption basically is very high, is very good. In particular, also in those jurisdictions that started with voluntary projects. And I'm going to make a few points a little bit later about why it might be right to follow that approach, namely voluntary projects with the prospect of a mandate. Now, what does research tell us about what do we need to have in place if we were to do the same thing, namely capital market projects for digital financial reporting in Australia as well? There is a few key ingredients that are critical. Number 1 is we need a robust reporting infrastructure for that purpose. And there is a number of elements for that. First of all, we need to have a taxonomy. And the taxonomy basically is that key element of the infrastructure, that dictionary, if you will, which lists or defines all the tags, XBRL tags, and it maps them to the standards. Now, the good news is that there is one available. The IFRS taxonomy, basically the IFRS Foundation and the AASB very meticulously, all right, they just basically, they update their taxonomy. And the other good news is that we have an Australian adaptation of the IFRS taxonomy. So that basically is there already. But what we need more of, as in for Australia, if we were to do this, is we need tagging applications. Obviously, if you're going to get preparers to do this, all right, they need to have tagging applications, namely those applications they're going to use, all right, to tag their financial report so that they can produce these digital financial reports. And this is just an example, basically, whereby you have, this is the report, obviously, the taxonomy is at that particular point, and then it's relatively straightforward to do the tagging. So that is one another element of that robust infrastructure. Obviously, one also needs the filing, the information gateway, or the portal. For example, this is as far as I could get. I cannot access the EDGAR system, the US SEC, but essentially all filers will need to be registered. And when they prepare their reports, all right, they can basically upload them via that particular infrastructure, that the filing portal, all the information, excuse me, gateway. Now, what else? Now, obviously, these regulators are going to be pulling these masses, all right, of digital data. Why is that? Well, one reason is so that they can perform their regulatory function, their monitoring and supervision. But the other part is so that users can benefit from that. In this particular slide here, there is an example of an analysis, a digital financial analysis tool in this AASB, for example. All right, and what this is quite neat, because this integrates really well, all right, with EDGAR, all right, in the US. Okay, and what you can see in this particular example, how clearly you can see, but there are 4 companies in the airline industry in the US, and you can compare them. And this can be done in a very straightforward manner, or whatever you want to compare, you can run those comparisons. And therefore, as an investor, one can make their decisions about who might be the better prospect for their investment. But that is, again, in the same jurisdiction. The technology goes further. If you look at this other example here, which is another cool tool, well, that rhymes, cool tool from Iris. All right, you see here, for example, you have an analysis tool that is pulling data of different companies, namely one that is using the US GAAP standards, ExxonMobil, another one that is in Romania. All right, obviously they, I think they're using the IFRS taxonomy, and as you can see, you can now compare, so to speak, apples with apples. All right, you can run their ratios or KPIs or you name it, and you can, in a very straightforward manner, basically compare their financials in that particular sense. Now, obviously, one can argue that all of this can be done pre-XBRL, yes, but it takes a lot of work. All right, it takes, and the mom and pop investors obviously it will take to them way more effort. All right, to reach this. XBRL or the technology or DFR does that, all right, in a very neat manner, as these examples show. Now, where can you get these tools? This is basically showing, for example, it's a snapshot from XBRL International. There is tons of tools available. As I showed earlier, all right, there are many jurisdictions that have been working a lot in this space, and therefore the software developers and vendors, they have come to the market and they've provided their tools that can be used in this particular space. All right, what else? And this is another one, for example, the US Financial Accounting Standards Board. They also list tools that are available. And obviously, we are never saying, because if you look at the ugly code here that I showed earlier, no preparer is expected, oh, come on, go, yep, no preparer is expected to do the ugly code manually. The tool support is critical in this particular context, and those tools enable the preparers and the users to essentially basically see these make these analyses much more effective. Okay, now what else? Another point that is critical that we're learning from research is data quality. In the earlier days, in these jurisdictions where XBRL was mandated, there were data quality problems. In relation to that, in particular, in relation to the technology tools, because at the time they were not very, very mature. But irrespective of that, it's critical, all right, for us to have tools. And why? Because we need to have confidence that all users, all stakeholders in the business information supply chain, they need to have confidence that if they're using digital data, that's quality data. And that's why, and of course, there is other issues that we could have, namely, there is reputational risks, liability risks, and of course, regulatory risks as well. All right, more recently, for example, this is what they said in the EU, in the sense that integrity, all right, and data integrity is important, but I've highlighted or underscored basically the point that is important here. Users should be granted the same level of protection, irrespective of how they access that, whether we're looking at standard, dumb, scanned paper, PDF documents, or electronically structured document. And by that, we are specifically referring to digital financial reporting, or XBRL documents. How have these jurisdictions addressed these quality issues? There is a number of ways, all right? So one is, for example, by using regulatory checks. For argument's sake, remember how we said earlier that filers or preparers of issues, they go and upload these files. So at that point, at the upload point, the regulators can run certain checks. The preparers are those that are, they want to be careful, they can run them even prior to that. But there is documented filer manuals, for example, both in the US and in the EU, all right, that essentially help preparers to make sure that they have a level of quality. But in addition to that, there is also a role for auditors and assurance providers, essentially, because what we need to make sure, when we're talking about digital corporate reports, we could end up having two versions: the typical audited traditional format report, but also the digital financial report. And we need to have confidence that one, all right, is the same as the other. And obviously, that's not necessarily the case, particularly if basically there is problems in relation to tagging. I mean, for example, common errors that necessitate assurance are monetary versus percentage values. And this is what research has shown in the past, or scaling errors. That's why there is a very important role for auditors to ensure that data level assurance and tag choices are made appropriately. And of course, that the material misstatements as a result of tagging errors basically are not very significant, or maybe are very significant, and auditors basically could help achieve that. What research always seems to show, there's a common point there, is that preparers they need support, especially in the earlier phases of that adoption. And of course, I'm singling out the preparers, but it's not only them. I also mean other stakeholders as well. And obviously here, that support would come from regulators or stock exchanges if they're going to play an important part in this process, professional organizations, and why not, of course, software vendors, because they are offering these tools. So they have to take their fair share of responsibility here as well. And another point here is that it's also, and the support should come in the form of education and training. Obviously, when we talk about training, typically we tend to refer to how to do it, but more importantly is why is it worth doing, all right? And obviously those benefits, so it's having that motivation that, look, this technology might seem hard in the beginning, but in the long run, everybody, if we adopt it as an ecosystem, everybody has got something to gain in that particular point. But also we need to recognize, if we're going to do this in Australia, all right, properly, that there will be some teething problems. So in every country that I've looked at in our research, basically, is that there's always something. And that's why here the point that I wanted to make, that I highlighted earlier, is that voluntary projects with the prospect of a mandate can be particularly useful in this particular context, because during that voluntary mandate period, you can discover what those teething problems are and do something about it, so that regulators and all of these stakeholders, they can then try and help the preparers or the issuers to do things right, as opposed to hit them with fines, which would be unfair. All right. The beautiful part, if there is anything basically we can draw, that is that there is a massive and rich experience overseas that we can draw on, basically, because as you could see earlier from how long this has been going on, there is that experience is there. And if we're going to do that in Australia in the context of capital markets, we can obviously rely on that. I hope I kept with the time, and hope I did not take more than allocated. But
no, you're pretty bang on there, Professor Trishani. Thank you so much for that, a really insightful presentation. And I think it sets us up nicely for our panel presentation. So really great panel with a number of different important perspectives. We've got Dr. Keith Kendall, of course, chair of the Australian Accounting Standards Board, and a really, a long more than 25 years spent across accounting, taxation, business law, and government, bringing a really well-rounded perspective to the AASB's projects and strategic direction. I think it's fair to say has become a really important voice actually on in support of digital reporting. We've got Professor Peter Wells, who was until recently a professor of financial accounting at the University of Technology in Sydney. And his research primarily is in the area of financial reporting regulation, although he's done research and published in all the right places across a number of different topics. And I think Peter's done some great work for us at CAANZ, writing a paper and working on some stuff now. But I think I'd have to say has played a really critical role in sort of advocating for the adoption of digital reporting. Very powerful testimony given to the Parliamentary Joint Committee that was looking into this a couple of years ago. We also have Rebecca Morgan, Head of Finance at the GPT Group, who's spent 20 years working in the property industry with roles at EY, Dexus, New City, based in Japan, and Rawson Homes as a CFO. As well as looking after day-to-day finance functions. She's been involved in quite a few system implementations, including in ERP systems, and she's one of us here who has actually worked and got her hands dirty with digital reporting over in Japan, who of course have adopted their own version of digital reporting. And last but not leastly, David Hardage, who is an expert providing authoritative leadership on financial reporting and the audit response in the not-for-profit and for-profit sectors. And some may not know that David, when it comes to promoting the use of digital reporting, has been around from the very beginning, actually as the XBRL Australia representative on the XBRL International Steering Committee and a co-chair during the very early years. So it's, I think, maybe more than all of us, David is feeling like, well, can we just get on with it? So we've got some questions which we'll go through, but please do keep those questions coming through the chat. Already a couple of good ones that I saw some of our panelists have sort of thrown some answers in. But firstly, if I can turn to Dr. Kendall. Recently, the AASB added digital financial reporting onto the work program. Can you tell us a bit about that work that the AASB is doing around digital financial reporting?
Yeah, thanks, Amir. And yeah, you're right. That's been added to our work program under the heading of monitoring in terms of developments. That was as a result of our agenda consultation process that we undertook late last year and earlier this year. So one of the things that we discovered that, or probably more correctly confirmed, as part of that process, was that there was a very large degree of a lack of understanding of what digital financial reporting actually entails amongst our stakeholder community. And Professor Trishani alluded to a lot of this, not our consultation process. It's just, but more generally speaking, that so when he started off by pointing out how, well, digital financial reporting doesn't mean PDFs, that's pretty much where we're going from with that. So what we found was that there was a reasonably sizable minority of our stakeholder cohort that understood digital financial reporting, was quite well informed, but the vast majority, and I would say it was about 80%. So that's the sort of figures that we're talking about. About 80% of our stakeholder community didn't understand what digital financial reporting actually is. So what that indicated to us is, without preempting adoption or anything like that, a lot of what we're talking about today has a very strong view towards adoption. Now that's certainly something that takes a number of considerations into account, but a first step along that path is to actually educate our stakeholder community as to what digital financial reporting is all about. And that was one of the other elements of Professor Trishani's presentation there. And I do hasten to add that that wasn't a setup at all. It just shows that we all seem to be on the same page here. But what Professor Trishani was saying in his presentation there is how important an education aspect is required here. I feel comfortable in that everyone on the panel would agree with that as well. But that does demonstrate that the education campaign needs to be quite extensive. I'm loath to put a time frame on it, but that we will need to have quite an extensive education campaign to try to get that level of knowledge and understanding up to a much broader level before we can talk seriously about adoption. But as part of that, well, this event is also is part of that education campaign. But also as part of that, is in terms of like what Professor Trishani was going through with aspects of the presentation, describing the benefits and the advantages of digital financial reporting. So we're conducting a lot of research. There'll be, which includes going through the relevant literature, also talking to stakeholders, conducting further outreach. These are the initial steps that we're doing at the moment.
Thanks, Keith. And so if I can turn to you, Rebecca, unlike a lot of us who are very passionate about this, but maybe haven't quite put our toe into the water, you've actually worked with a real life and done, maintenance and the day-to-day running of a digital reporting system. Can you tell us a bit about your experience there?
Yeah, sure. So I actually started working in a role in Japan for a property company over there called New City Corporation back in 2007. In 2008, Japan implemented the XBRL framework for their reporting. Now, given that when I arrived in 2007 at New City, that company was already producing XBRL reports, I would say that they must have had a voluntary regime before that. The way that company did it, and a lot of other companies that I had contact with in my time over there, was they had a reporting platform over there called Kanjo Bugyo, which is sort of a standardized reporting piece of software. It only produces accounts in Japanese, so I was looking at the output of it without any ability to actually read them. But that had a standardized reporting framework in it. So basically it had a standardized chart of accounts in it, and you had to map into that. So when I was over there, we were doing an Oracle ERP implementation. And one of the first questions that I asked in doing that implementation is, why is it that our consolidation is being pumped across into this other reporting software and being done out of that reporting software? And the answer that I got was, absolutely, we have to have this piece of reporting software. It produces the regulatory output that is required to be lodged in Japan. So what we did was basically just map our system, which was Oracle ERP, across into that Kanjo Bugyo system, such that it could output the XBRL outputs. So the one benefit, which I sort of touched upon when we were having a bit of the pre-chats about this presentation, was that because they had a standardized taxonomy in that reporting system, it meant that you didn't end up with issues in terms of period to period changes in classifications. So, if you had something that we reported as revenue and then it flipped into expense, because of the fact that it was actually mapped, that account was mapped through, that account would always have the same reporting tag applied to it. Whereas I think that in Australia, certainly there is quite a bit of reallocation to ensure that your comparatives and your current period reporting is on the same basis, so that you've got, you know, like for like on a row by row basis in your accounts. So, so that did get around that problem. But I don't think that that's necessarily what we would prescribe in Australia were we to go down that path. I think, Indra, you touched upon software packages and what sort of software packages are available and what can support XBRL reporting frameworks in Australia. At GPT, we've actually just put in Workiva, which comes with that functionality out of the box. It's quite broadly used in the United States, and is pretty much ready to go from an Australian perspective were we to go down that path. So thankfully, from a GPT perspective, we're a bit ahead of the game in that our accounts are already produced out of that accounting package, and we just have to enable that functionality.
Well, it's great to hear. Maybe you could be a first mover. No pressure.
Well, I actually do think that a voluntary reporting framework is an excellent idea, because it allows bigger companies like ourselves to make the mistakes first, and then pass that knowledge on to some of the smaller companies so that they don't have to go through the pain. They just don't have the resources to do that.
Yeah, no, it's certainly, it makes a lot of sense. Certainly, I mean, and there is, of course, an ability to do voluntary reporting, which I think has been in place, at least with ASIC, for, would it be about 10 years, I'm going to say. Yeah, one of the things that would probably make a big difference, as you say, Rebecca, is if you had some big first movers to show everyone that it's not as scary as what it might seem. And we appreciate your voice in that as well, having sort of been a part of this before. If I can move to Professor Wells for a moment, can you talk to us a little bit around the costs and benefits of implementing digital reporting, something that you wrote about, I think, really comprehensively in that Future of Financial Reporting paper that you did with CANZ a few years ago. But what are your thoughts around those costs and benefits?
I think we can think of it from two perspectives. We can think of it from a user and a preparer perspective mainly. If we think about users, I think the jury is 100% back on that. And if we look at the US experience, when digital financial reporting was implemented, we look for the 6 years subsequent to that, we can see that users accessed information on the SEC electronic database, EDGAR, 2.3 billion times. Of those accesses, 90% were done by computers, robots. So what that tells you is that users clearly have identified that there are significant benefits from having access to this information, and they use it very aggressively. So I think we can quite clearly say that the users definitely perceive there to be a significant excess of benefits over costs just from their actions, and actions always speak louder than words for me. When it comes to preparers, I think that there are a number of misconceptions. And one of the big misconceptions is really that adopting digital financial reporting has to be expensive. Yes, it is going to be expensive if you have very bespoke financial reports and if you have the manual tagging of those reports. It's also going to encourage companies to use tag extensions, which undermine the appropriate or the efficiency of tagging, and it's going to give rise to errors. Those are all experiences that we've seen from the US. And you've got to ask yourself the question, when companies go down this path, are they really interested in financial reporting, or are they more interested in marketing the firm to the investment community? In which case, we've got to ask ourselves the question, is this an appropriate strategy? So bespoke financial reports, manual tagging, filthy expensive. And that's what a lot of people probably tend to focus on. However, it doesn't have to be. There is software available, and one package I'm aware of, it costs $7,500 for a single user license. And just as people currently use caseware and other software to prepare financial reports, they could equally well use that same type of software to prepare digitally enhanced financial reports. It is not going to change the way in which a vast volume, most financial reports are prepared, which is using financial reporting software. It might just be a different software or an enhanced software. So it is not going to radically change the cost or the way in which people go about preparing their financial reports. There was a survey which was done by the American Institute of Certified Practicing Accountants about the cost of digital financial reporting for firms in the US. And they did a survey of almost 1,300 small firms. And what they found was that the cost of preparing the financial reports and filing those financial reports with the SEC, for more than half of the firms, it was less than $10,000. So preparing digital financial reports need not be expensive. And we need to understand that when Australia does go down this path, we will not be at the bleeding edge. The technology is old, tried and tested. It is already fairly cheaply available. So cost should not be an issue for any firm. And I'm a director of a not-for-profit, and I can tell you that our financial reports are prepared using caseware. So even for a small business which has a modest turnover, then it is still going to be a fairly cost-effective, non-shattering experience for us to shift to digital financial reporting. And for the likes of the ACNC, it's going to improve their efficiency an awful lot. In terms of the benefits are going to be enormous and totally in line with what you'd expect from the finance literature. As soon as you get more information, more accurate information, more rapid information, then immediately you get a whole sequencing of benefits. Cost of capital, reduced spreads and loans and margins. You get more rapid price adjustment. You get less price variability. And I think one of the challenges for people like Indra who work in this space is that it's quite a challenge getting some of these papers published in the conventional accounting journals, because they sort of say, where's the contribution? We knew this already. And so a lot of the papers actually appear in the information systems literature. So it's not a surprise that any of these results are coming out of the literature in terms of the benefits of digital financial reporting. It is just predicted straight out of the finance theories that we've had for the last 50 years. So it's a bit of a no-brainer, I think, in terms of the benefits. And I think the costs, people need to go back and think about what they're trying to achieve with their financial reporting. And if they're trying to achieve a marketing outcome, maybe they need to think about whether that's appropriate for a financial reporting document. And maybe it's better sometimes that we use alternative medium or mechanisms for providing information to investors. For example, a lot of firms have quite substantial investor relations websites, and information can probably be provided through those mechanisms a lot more efficiently these days. And maybe the decisions we see today about financial report formats are driven by decisions made 50 years ago, when the financial report was probably seen as the primary mechanism for communicating to shareholders. If that's the reason, then I think we need to go back and revisit that decision.
It's a really compelling argument and some compelling stats there, Peter. I'd add maybe on to that, we recently did a study, actually so recently we haven't published it yet. So this is, this is a sneak preview here just for those on the line. We survey each year about 1,000 retail investors, people who are mostly investing 10,000 or more in the stock market. And this year we asked them about digital reporting and complexity. 77% said that they find financial reports somewhat to very difficult to understand. 86% believe digital reporting would improve that. 70% support or strongly support mandating digital reporting in Australia. So that's a poll. Look, you can say what you will about polls, but we've invested in that research, just like any other sort of major poll, to have the sort of robustness of the population. And the answer is pretty clear right there. If I can finally go to David. David, what are your thoughts on implementing digital financial reporting in the for-profit and not-for-profit sectors?
I mean, yes, I think you need to sort of look at the use cases. So Peter's already mentioned the benefits, which is, quicker information, but it's also more that you can access the information using a computer machine instead of doing copy and paste. So the computer with the tags that Professor Trishani mentioned, you can actually, the computer can actually understand what that figure is, that it's revenue for that company for that financial year, and it's in millions of dollars. And it can suck that information directly in. So it's about getting access to that information more accurately and quicker. As Professor Trishani also mentioned, some of the new reporting requirements and regulations that are coming through are going to start moving to digital reporting, at least overseas. And so we probably will get that with sustainability reporting, at least sort of overseas companies, which means that Australian companies will tend to potentially get left out. So if we look at the public sector and not-for-profit sector, that's a little bit different. It's not so much focused on profit and financial reporting. Yes, you've got to make a sustainable return, and there's some other factors, but I think it's more in the non-financial side of things, or service performance reporting, that that project is called for the Standard Centre. And for the state and territories, I had a go at comparing hospital departments and health departments across states. Education departments, and that was on the basis of the media and reports of declining education standards compared to the international PISA standard. So I had a go at looking at how they evaluate themselves, and it's a lot in the glossy, not in the statutory financials. And they all seem to have their own metrics of how they looked at each other, and I think only 2 out of 4 actually referred to that PISA standard. I think only 1 had a metric, so it was rather difficult, and possibly an indicator of some of the complexities we'll have with sustainability reporting in XBRL, with people coming up with their own tags. In terms of local government, I had to try to look at across local governments on how assets are valued and particular characteristics, and it was hard because I had to pull it out manually. But if we look at local government, most of the states and territories seem to have their own financial sustainability ratios, but they seem to be different. And while XBRL could help, I think that they've probably got that sorted out. Each particular council coming up with their own ratios. In Queensland, we report and give an audit report on it. And yes, it would be good to have it collected, but whether we want to tag everything to get those ratios, I'm not too sure of. If we look at not-for-profit and charities and look at, well, how do I evaluate a charity? There's 50-odd thousand charities. Well, the ACNC already has a register, a revamped register that's looking pretty good. So do we really want to require all these charities, including lots of small ones, to tag up things when we may not use the information because we're actually looking at non-financial information? And if we look at non-charity, not-for-profits, there's a few 100,000 of them, like sporting clubs. Do we need them to tag up their financial statements? I'm not really going to choose a local archery or basketball or soccer club based on their financial performance. So let's look at the use cases. I think particularly in the private sector, it's much stronger. And if that comes out and gets worked in and we get the software, then potentially some of the larger organisations, we would benefit from an automatic XBRL exporting. But let's start with the private sector, and particularly large, and I'd personally go with listed.
Thanks, David. We've got a lot of great questions actually that have come through, so that makes my job a little bit easier. One of them, which relates to my sort of pre-prepared Dorothy Dixer that I had in mind, is how many companies in Australia have started voluntary XBRL reporting. And I'm going to reference the ASIC chief accountant's excellent joke that it's a very round number, as Peter has indicated there. It's the roundest number of all, 0. Let me maybe go around the panel now, and I'd like to ask each of you this question. Why is that the case? Why we all have just passionately said why we think it should happen. Why isn't it happening? And if maybe I'll go the same order. So Keith, if you don't mind me starting off, throwing to you.
Well, that is a good question, Amir, and I have to admit, I suspect, like most people, when they hear that, I was quite surprised to hear that, especially when one considers that there are a number of dual listed companies in Australia who need to file digitally in other jurisdictions such as the UK and the US. Look, the feedback that I've received in some of my ad hoc discussions with industry participants, preparers, is that they're to Australianize the reports digitally in those circumstances is still too expensive. Whether you agree with that or not, because I know the expense of preparing digital financial reports has already been addressed. Whether you agree with it or not, that is beside the point. That's the feedback that I've been getting. Now, and if I can go a little bit on a limb here, looking because this is necessarily speculative, why the number is so round, as you say. But one of the reading between the lines, and this will form part of the education campaign, I think, in terms of trying to change a mindset, is that digital financial reporting, digitizing the financial reports, is seen as an additional compliance obligation. So it's just one extra step that's being tacked on to what preparers have been doing for the last 30, 40, 50 years. So the process at the moment is that they prepare the financial reports in the traditional way, and then the tags get added on. When it's approached in such a way in that it's just another compliance obligation, you can start to understand why preparers are aren't exactly falling over themselves to go and do this. Like I say, now that before anyone starts reading into my comments something that isn't there, that's not my view. That's not how I view it. As Professor Trishani's presentation and the panel has been discussing, there are quite a lot of benefits to this that go, and it is not just a compliance obligation. It's just another way of presenting the same information. So it shouldn't be seen as an additional compliance obligation. It's just a different way of doing what has been done. But that's not the mindset at the moment. That's my best guess. So
yeah, no, I think, and whether you agree with those points or not, it's certainly what I've heard as well in terms of some of the concerns and fears out there in the market, and I guess part of the education program that you talked about, Keith, might be to help inform some of that. Rebecca, are there any sort of echoes here of what you saw? It sounds like in the early days in Japan when this was being adopted. Do you have any insight from there why we're struggling so much?
Look, as I said, I arrived there in 2007 and it was mandated in 2008. So I didn't really see what came before that. But to talk to why it is, I mean, as a preparer, it's certainly not something that we have considered doing here at GPT. And I would say that the reason for that really at this point in time is actually investor pool. So I think in order to make that data truly useful, it has to have a place to go. So there's no point in me sitting there and tagging, all my statements if there is nowhere for me to then go and put that information such that it can be ingested by my investors, unless they have their own ingestion tools, and I'm not sure that they do. Whereas I have seen pull on a lot of other European requirements from my European investors that we are stepping up to provide. So until the investors start to ask for it, or until it's mandated, there's obviously a lot of effort in going and doing those tag statements, and we wouldn't probably direct our efforts in that direction until one of those two things occurred. We've just gone through the process of doing integrated financial reporting, and obviously that took a lot of effort. So you tend to direct your efforts towards the place of greatest need.
Yeah, that sounds very fair, actually, and I think it goes to, if I would dare to add a personal view, often you hear about a mandate as a bad thing. It's like a carrot and stick, and that's the stick. And ideally, we should be doing it voluntarily. But I think a mandate or a law is really just the way that we standardize reporting in our society. And as you can see from, we've talked about the chicken and egg. I think sometimes, investors won't ask for it until it's provided, and won't be provided till they ask for it. Maybe the midwife for that chicken and egg needs to be some kind of a legislated mandate. That's how it works with reporting.
Yeah, I mean, I would assume that the legislated mandate would come with an infrastructure around it, similar to your Edgar platform in the US. So, there's no point in us doing something if it has nowhere to go.
Mm-hmm.
It doesn't help investors unless they're particularly sophisticated in accessing that data. And
that's, of course, not the audience that we're mainly trying to, I think, serve through this. Peter, what do you think? You've spoken at length and written about this quite a lot. Why are we so far behind?
I think a lot of it is just a lack of awareness. And I remember a few years ago, there was a comment coming from a grouping of CFOs that they didn't like the idea of digital financial reporting because it reduced their ability to tell the story that they want to tell in a financial report. Now, digital financial reporting does not change the format of the annual report 1 inch. And so that's why I'm saying it's probably an awareness issue. I think a lot of firms probably also approach the financial report in the same way that auditors approach their task. Why did the auditor cross the road? Because it was last year's working paper. That's probably what happens with financial reports as well. And I think investors get used to looking at financial reports for a particular firm which look the same every year, and that helps them to make the comparison and to make that individual firm's reports more understandable. Now, whether that necessarily applies to a broader sampling of firms, I would highly doubt. So I think that those are probably some of the challenges out there. I think what really needs to happen if we are going to realise the majority of the benefits is we do need a standardised repository like Edgar, and that has to be ASIC. I don't think there's any doubt about that. And that would allow the efficient harvesting of information from a central repository, and that does have some implications for ASIC's charging regime, which does reduce transparency in our financial markets. So that's probably not the answer that ASIC and truly want to hear. But even if we didn't get down that road as far as we wanted to, maybe we should think about just what happens with every time a small business or a business goes along to the bank and they provide their set of financial statements. It gets sent off to the Philippines, it gets put into a standardized format, it comes back to Australia and it gets used. And the first thing the person who's using the financial statement has to do is make sure that the balance sheet balances, which it typically doesn't. And they need to make sure that the income statement and the balance sheet articulate. It typically doesn't. It's done really badly. So any firm who provides financial information to a financial institution or anyone should really be advocating for this so that they can actually have an effective communication process, because to be perfectly honest, it's not happening at the moment. And that's maybe a realization we need to have.
Yeah,
does that answer your question?
Very much. And I think, but maybe in fairness to ASIC, I think they have certainly advocated and done a lot of work towards this. Maybe they need a bit of backing to get to where we need to from the rest of the the Parliament, government, as I think you suggested earlier, and Rebecca sort of pointed to as well. David, so 20 years ago, this must have seemed fresh, new, and exciting, and I bet you were marking it in your calendar for 2001, maybe, that we were going to adopt excitingly. What happened in your view?
Well, it was exciting, and yeah, very disappointed as an Australian. because the context was that in the US it was voluntary at the start, and they did have people lodging. So you had a different attitude towards innovation. So there's something like 20 odd companies with a market capitalization then of over $1 trillion that were producing their financials, who were members of XBRL, the US organization, and were doing their voluntary financial statements. So yeah, potentially a different attitude to innovation. Dr. Kendall mentioned mindset. So if you look at it a different way, it's like, well, you're already spending how much money on your glossy financial reports and all the photographs, and you're not making it digitally accessible or accessible to computers. What's going on? And then I think it's also important, as Rebecca and Peter mentioned, that the repository. Now, where do you put this? And I've sort of asked the question, well, if someone did lodge a set of XBRL financial statements with ASIC, where would you go? And you'd probably have to look up the individual company and then pay for the download. Now, I do note that there was an announcement, I think, in the last budget. I'm not too sure if it's LA law, LAW law reduction in fees from about September 2023 when the new registry system comes in. But there were some caveats as to maybe retail. So there might be some possibilities of having a central repository for free when that comes through. I think that would help. But there's certainly, listening to Dr. Kendall's feedback from people, my understanding is obviously different to what they have. So there's an education process there. And Peter mentioned it as well about changing your financials. Well, the whole idea and what we talked about 20 years ago was you didn't have to change your financial statements. You could report whatever you liked in whatever format. That's why, we've called it X as in extensible, which causes all sorts of problems with tags, which is another story, but you don't have to change your formatting. But yeah, that message seems to have got lost as well.
So we've got some great questions here I might go to from the floor. So thank you for everyone putting them in. Maybe I'll try to link some of them together or ask a couple at a time, because some of them are quite related. One that's interesting here is for some of the high profile financial disasters over the years, wouldn't this assist the regulators and especially spare them criticism that comes with inaction? And I think that's related also to number of questions that point to the link between digital reporting, accountability, stewardship, and understandability. There are a couple of questions that really point to the just the increased accountability that comes with digital reporting, I guess, in this. Maybe I'll go to Peter. You've got your hand up there. What are your thoughts on that?
I think in terms of enhancing the quality of financial reporting or the use of financial reporting information, digital reporting is the only way to go forward. And if for no other reason, ASIC should be supporting it for this. In Denmark, they have digital financial reporting there, and their regulator does a scanning of 100% of company filings. In Australia, ASIC does a random small sample. And just an idea of the magnitude of the potential problem here, when we looked at a sample of firms over about a 10-year period who were recognising asset impairments in Australia, less than half of firms with at least one external indicator of impairment were recognising an asset impairment, and that could persist for over 2 years. So ASIC comes out and says that every year that there's a problem with recognising asset impairments. The empirical data says that it is, and if ASIC had access to good data and some decent quantitative techniques, then I think you'd find that there'd be a lot higher level of compliance with accounting standards. And it also comes down to, you could become a lot more critical about how recoverable amount was calculated. So I'm playing on impairments here. One of the problems that I've seen with one impairment recognition or non-recognition was that they assumed a growth rate in their terminal value assumptions, which was greater than their sales growth rate. Now that practically that implies a increasing gross margin and net margin forever. And I'm afraid costs can't decrease forever, so that's actually technically impossible. So it would allow ASIC to be a lot more critical of the assumptions, the reasonableness of the assumptions, and that would, I think, do an enormous amount to start enhancing the quality of financial reporting that we see in Australia.
Any other? David?
Well, the US SEC is already doing this. If there was an ASIC did a digital financial reporting webinar about 12 months ago. It's available on YouTube. Listen to Mike Willis, who's from the particular SEC department. Mike was one of the early evangelists with XBRL, so I knew him 20 years ago. He talks about what some of the examples that they do and what the staff can do, and essentially it's what Peter said. Go through 100% of the companies looking for odd things. The SEC also do sentiment analysis as well, very sophisticated analysis. Whether the system would pick up a Wirecard, don't know, but at least you've got a framework of, well, we're looking at you and going through 100% of the financials to look at anomalies and risk. Yeah, so it looks a very powerful system over there.
And the best part is that this can probably have some AI, artificial intelligence, embedded systems that you wouldn't even need people, all right, to look into this. As in, the system itself will have that capability to learn from past experience and then basically pick offenders, so to speak. Of course, we need to be careful because AI can learn the good things, but also the bad things. But that's another issue. But it would automate that particular process.
Yeah, it certainly seems like a given that that if you can't absorb the information using that type of technology in this day and age, given the volume of information out there, then it's in some ways akin to not having the information in the first place. And we're sort of heading fast to that. One of the interesting, I think, issues here is actually making the reporting consistent, and internationally, I know this is an issue that the IFRS Foundation has been concerned about, is fragmentation across different countries. It goes a little bit to the research which Professor Trishani shared earlier. But there's a question here that asks about whether the AASB is going to, or maybe already has, mandated a uniform XBRL structure in Australia to ensure that the data can be consumed and processed consistently. And if there's no XBRL schema, would the information be useless? But I think there's a fairly straightforward answer to that, right, Keith?
Well, we haven't gone and mandated anything yet. That's certainly, we're certainly nowhere near that stage right now. However, the IASB does prepare a taxonomy based on IFRS. Without speaking for the board, without preempting anything, I would anticipate that would be the basis on which we would do anything should we go down that route. With Australian modifications, of course, and we've referred to the Australian taxonomy that's been dealt with a bit in this seminar now. But the question really raises one of the significant policy questions. Now, I've done some seminars on this, talking about the work that we've looked into and the like, and I hate to disagree with you, Amir, but this is actually not that straightforward a question, although this aspect of it, at least in terms of tagging and the extent to which tagging should be allowed, as has been noted, I think, in the Q&A that's been going. One of the problems, so the Americans had a lot of problems when XBRL was first mandated, and one of the sources of those problems was the extensive custom tagging that went on. So that does raise a question, well, should custom tagging be allowed? If yes, to what extent? And there are also a number of middle grounds that can be adopted. So, for example, with my discussions with the AASB and the FRC lab, which is the research arm over in the UK of their Financial Reporting Council, they talk about a process called anchoring, where a custom tag still needs to be anchored to something within the taxonomy. So that might mitigate the non-comparability concerns to a certain degree, whilst also accommodating concerns from preparers saying, well, I don't neatly fit into these boxes here that you've prepared for me. So that's a significant policy design question that we would need to consider, think through, consult on, of course, before we actually settled on a final solution. So it's not quite as simple as it might sound at the start.
No, and I guess internationally becomes even more complicated again. One of the questions here is quite interesting is, could big data capability leapfrog digital reporting in the same time frame? And it refers to entities making available voluntarily and or mandatorily their underlying data, such as the general ledger. I don't know if we're quite there yet, but Rebecca, that sounds pretty scary, I imagine, for any CFO to think about even today. And there's there are so many other demands for data. I mean, there's data aggregators and the sustainability world kind of players demanding this data, which we all hope will be improved to some extent with standardizing that. But what do you think about that? Or if you can even just comment generally about the demand for data and how this might help.
Certainly in terms of financial data, I would say that there would be a definite amount of reluctance for most big organizations to allow their general ledger out into the public domain. Obviously, there's a lot of commercially sensitive information in that ledger, and you'd be giving away a fairly significant competitive advantage by giving away that data. So I certainly can't see that occurring in my lifetime, to be honest. Whereas, the stuff that at the level that you see it in the financial statements, you've effectively aggregated away a lot of that more commercially sensitive data. And so I can certainly see that being digitized as we're discussing here. But I think you can only peel that back a couple of layers before, you're at transactional data, and that's certainly not something you're going to release to the public.
I think you've just answered one of the other questions there as well, which was whether the data available is going to be for each transaction or just the financial statement line items. And I think, as Professor Trishani sort of outlined there with the demonstration, it really is the information in the financial report put into a tagged, machine readable format.
It depends also on the strategy that the preparers have adopted, because on the one hand, many preparers, they have adopted the bolt-on approach. So they go and do the financial reports in the same way as they've always done. And then at that level, they go and convert them into XBRL, all right, in that format, and then they file them. On the other hand, there have also been preparers who have backwardly integrated their systems to catch their transaction data at general level in XBRL format. And that is the best outcome that you could have in this particular instance, because that is the outcome of the process whereby you're going to achieve those process efficiencies, basically. And so in a way, what you can do with that information depends on how you implemented that to start with.
Thanks for that. And then Peter, I think you had a comment, and then we've got to move to our final sort of thoughts.
Yeah, my comment was really just about the tag extensions, because that is something that I think people need to just think about and discuss. When they started to have XBRL reporting in the US, some firms had up to 50% of their tags were extensions or customized tags. And that level of customization meant that the whole process was pretty much a waste of time because machines couldn't distinguish, couldn't make the appropriate comparisons. It just didn't work. The SEC ultimately responded by coming out and saying, do not use extensions. I think that's quite the ideal situation. They didn't enforce it too slavishly, but they got the principle across pretty clearly. And I think the idea that down to a certain level, the tags must be followed exclusively. And I think below that level, then you can have more tags. And that's where the idea of anchoring comes up. So that you might have more information about a particular component of your financial statements. Yes. That might be interesting to people who look at your financial report in particular, but they're not actually making comparisons across different firms. So it's when you stop making comparisons across firms, that's when extensions, I think, start to become interesting or relevant. But if you're producing data to be compared across firms, then extensions just don't work. That's the antithesis of what we need.
Okay. So right, we're getting close to a wrap up. So maybe if I can ask each panelist, we'll go in the reverse order than the beginning. Maybe on a slightly more hopeful note, because a bit of this has probably seemed a little bit negative where we're at. But what are you hopeful about in terms of moving towards digital reporting as the norm in Australia? David, if we can start with your thoughts.
Look, I'm positive because I'm seeing particularly Dr. Kendall and others address some of the practical issues. So look, tagging is one that keeps coming up, and it's very important because when the computer compares one company to another, it's all linked to this taxonomy, and I try not to use it, and I've got laughed at for using the word taxonomy, but what it is this series of tags. So if you tag something to say it's depreciation and it's linked to the IFRS taxonomy, every time someone uses depreciation from the IFRS taxonomy, it's comparable. The computer can understand it. But if you've got depreciation as an extension in a different taxonomy, the computer can't compare it, even though the person thinks it's DEPRE, whatever it is, and it looks the same. But to the computer, it's different. It has to be the exact same tag, which is why Australia needs to have the IFRS taxonomy there. So some of these practical issues and the discussion on people's insights and finding that what they think isn't what we think is a real start. So I think it's a good base to come from, but we do need to find the person who's actually going to change the law to mandate it. I did have that question the other day and I didn't have an answer. Who do we have to get to sign the piece of legislation or propose the legislation to make it mandatory? Yeah.
Well, we certainly got Parliament who are willing to do things, as we found out, I think, last week when it comes to grandfathering. So you never know. I feel optimistic about that, maybe more so than I have. Peter, do you find any cause for hope?
I think that the fact that we're actually talking about it is a positive thing, because for so many years it was very difficult to get much attention being focused on the issue. And I think maybe one of the things which is going to lead to us being a bit more successful this time is that I think when it comes to financial reporting these days, I do think we're at a certain crisis point. If we look at the financial report for any large listed company, could any of us put our hand on our heart and say we can actually understand that report? And I venture to say even probably Rebecca would be challenged with looking at the GPT financial report. Sorry, Rebecca.
I can understand my own.
Yeah, okay. But my point is that it's got to the stage where they are so complex that we need to have aids to help us to look at the reports, to understand them, and to make valid comparisons across firms. And the only way that can happen, and we can take control of the reporting process again, is to have digital financial reports. And if you throw in sustainability reporting and whatever else is going to be in there, it is just going to blow out the complexity of financial reporting exponentially. So the only way we can control this process and make sure it achieves its objective is to go digital.
Thanks, Peter. And Rebecca, you ought to have a right of reply on that. And is there anything out there that gives you more cause for hope?
Well, I think my hopes are more around how we would go about implementing it in the future. I mean, I kind of see it as an inevitability because, you know, as more and more foreign jurisdictions adopt that methodology for, you know, tagging their accounts and investors are getting used to using that information, inevitably the pull is going to come to Australia. Otherwise, we're just going to miss out on foreign capital flows, which we simply can't afford to do. So I think that there's going to be a necessity to go down that path, and I personally would like to see the government get on the front foot on that and not wait until it's at crisis. So, but at the same time, I think it's a good thing that the AASB has it on its agenda now, because I want some time before we hit that crisis for proper consultation with business to ensure that you know, the legislation's not rushed through and it's not fit for purpose when it lands, which we have seen with some other reporting regimes. So those would be my hopes for the future in relation to digital financial reporting.
Oh, that's very fair. I think it's a great segue, fittingly, I think, to have the last say. Dr. Kendall.
Thanks. Look, in again, without preempting anything, the forces seem to be pushing us towards adopting digital financial reporting. So on that basis, I would say positive in the sense that I would see it come in. There are, as Rebecca's just alluded to, though, there's a number of considerations that need to be undertaken to find out. It's one thing to say, yes, we want digital financial reporting, right? That just then opens up a whole host of other questions as to how you're going to deal with this, how you're going to deal with that. So there will be a lot of consultation, there will be a lot of discussion, but in terms of forces nudging us down this way, as well as other jurisdictions adopting, like Rebecca was talking about, and effectively market forces effectively requiring companies that are dependent on foreign capital to adopt and basically compete in those investment markets. Like Professor Trishani noted at the start of his presentation, there's an expectation that sustainability standards are going to be reported using digital reporting from early on, if not day one. So it's probably going to be pushed through other means as well. So all the indications seem to be ultimately adopting digital financial reporting, but there's no way I'm going to put a timeline on that.
Well, thank you, Keith. I think that'd be pretty courageous if anyone was going to do that. Look, I think that wraps it up. Thank you very much to all of our panelists. Of course, Professor Trishani, our keynote presenter. It gives me a lot of optimism, I think, just this discussion and the great work and focus that the AASB has been putting on this. So thank you, and thanks to all those who've joined the session this afternoon, and we hope you'll go away and be able to be your own advocates in the circles that you dwell in for digital financial reporting. Thank you for the opportunity to lead the discussion. Eric, back over to you.
Thanks again, Amir, for chairing the session. Great discussions and insights. And thank you for CA, ANZ and CPA Australia to have this joint event together today. Before we end the session, I'd like to also mention that the next Dialogue Series session will be held on the 14th of September. The topic will be about the challenges and opportunities of external reporting for not-for-profit private sector entities. So we hope we will see you again. Many thanks for joining us. Have a good evening and see you next time.
Thank you.